Structured notes are sold, not bought. Welcome back to the channel. I'm Zach Palmer, certified financial planner with Ark Royal Wealth Management. Today, we're diving into a deceptive and complex investment that's being pushed on investors. Structured notes. Stick with me as we unpack what structured notes really are, why they often resemble a Vegas gamble, and most importantly, what you must watch for in the fine print before buying one. Structured notes are bank-issued investments that combine a bond with a derivative, typically a call option, tied to a stock index. They usually mature in 2 to 5 years and offer what sounds like an attractive return. But there's a catch. If the market doesn't perform a certain way, you could lose a portion or all of your investment. Sounds complicated? Well, that's because it is. And complexity benefits the people selling these products, not the investor buying them. Let's talk about a recent example we encountered. A client came to us with a product she was sold by her former advisor. The HSBC auto-callable barrier note with step-up premium. Fancy name, flashy brochure, garbage investment. Here's how it worked. The performance of the note was linked to the worst performer of 3 indices: the Dow Jones, the S&P 500, and the Russell 2000. You heard that right. The worst performer determines how your investment does. That's not diversification. That's what we call reverse diversification. With real diversification, you benefit from owning multiple asset classes. With structured notes, you're penalized by the weakest link in the chain. Unfortunately, in our client's case, 2 indices went up, but one, the Russell 2000, went down. The result? A 5-year investment that returned, you guessed it, 0. No dividends, no liquidity, and no transparency over 5 years. Well, I think HSBC should have used this clip in their brochure instead. And guess who did make money? The bank and the advisor. That note came with a 3.5% upfront fee just for buying it. Now, maybe your advisor told you there's downside protection. In this note, you wouldn't lose money unless the index dropped more than 25%. But once that threshold was breached, well, you're fully exposed to losses. So much for downside protection. Structured notes may feel diversified, tracking 2 or 3 indices, but that's a mirage. Because at the end of the day, your investment relies entirely on the creditworthiness of the issuing bank. If HSBC or any note issuer fails, your money's gone. No FDIC insurance, and it gets worse. Some notes don't track indices at all. They track individual stocks. So your performance depends on whichever company stumbles the most. Crazy, right? When we walked our client through all of this information, she looked at us and said, "This feels like fraud." Well, it's hard to disagree. At Ark Royal, we believe in the power of low-cost, diversified ETFs. Stock ETFs for growth, bond ETFs for stability. They're simple, transparent, and designed to help you succeed, not your advisor's bottom line. If your advisor pitches a structured note, ask, how do you get paid on this product? Who is guaranteeing this note? What are the risks if one index drops or the issuer goes under? And if the answers sound vague or complicated, well, that's your sign to walk away. I hope this helped you better understand the risks of structured notes. If you're unsure what's in your portfolio, or whether your advisor is working in your best interest, we'd love to help. Leave a comment if you've had experience with these products, and like this video if it was helpful. Don't forget to subscribe for more no-nonsense guidance on building a better financial future. Thanks for watching, and we'll see you next time.
If you'd like to learn more about the benefits of working with a truly independent and objective fee-only financial advisor, we welcome the opportunity to talk with you.